Chapter 8 is devoted to an analysis of the theory of central banking and free banking. There is a long tradition behind banking theory, though it was not until the first third of the 19th century was drawing to a close that economists began to fully grasp all that happens in the cycle, an understanding which has culminated very recently. In any event, we have already seen that the theorists of the School of Salamanca carried out quite a relevant analysis of how banks operate and the effects of fractional reserve banking. They made important contributions 3 centuries earlier, which unfortunately were forgotten. For example, they realized that deposits form part of the money supply just as paper money does. We have already covered this. Luis de Molina used the term chirographis pecuniarum, the written money banks generate as a mere entry in their accounting books. I say it was unfortunate because when the debate broke out in England between the banking school and the currency school at the beginning of the 19th century, with the arrival of the Industrial Revolution following the Napoleonic Wars, currency school theorists were correct in their analysis, in which they attributed financial crises to fractional reserve banking. At the time, banks' main business activity was the issuance of unbacked paper currency. On July the 19th, 1844, Sir Robert Peel the Younger successfully enacted a law requiring a 100% reserve ratio on the issuance of paper money. However, due to an oversight, the same requirement was not set for the issuance of deposits, and therefore the law was basically inoperative. Bankers redirected their business and stopped issuing unbacked paper money, but they began to issue unbacked deposits, and successive stages of boom and financial crisis and recession continued to recur. Members of the currency school were correct in their criticism of banking school theorists. The theorists of the banking school were seeking to justify the practices of fractional reserve banks. They developed a number of theories. For instance, Fullerton's law of reflux. Do not worry about expanding credit without the backing of saving, because that credit later flows back to the bank when entrepreneurs pay the discounted bills. Of course, that is a fallacious argument, because if the process of credit expansion continues, there is no reason loans cannot be repaid using newly created loans, and so on. Parnell, another theorist, urged, do not worry, because if a bank expands credit, it will fail, because it will lose reserves. Yet Longfield responded, you are wrong, because if all banks engage in expansion simultaneously, the interbank clearinghouse will not act as a safety valve that can resolve problems. Though the theorists of the currency school were fundamentally correct, they certainly committed a grave error when they left out deposits. In doing so, they overlooked a teaching of the Spanish scholastics, of Luis de Molina, who taught that deposits are just as much a part of the money supply as banknotes are. And, for that reason, they also require a 100% reserve ratio. Currency school theorists committed another grave error as well. They thought the way to limit private bankers was to create a central bank, so the Bank of England was given a monopoly on the issue of paper currency. The historical process is quite clear. Since the law was not enough to prevent crises, every so often private banks would fail. And to avoid failure, they needed a lender of last resort, the Bank of England, which would promptly suspend Peel's Bank Act, issue all the paper pounds necessary, and lend them to private bankers, just as in the recent bank bailout in both England and the United States, etc. Still, since gold cannot be created out of nothing, if all the necessary liquidity was to be provided, people had to accept paper pounds. So, legal tender laws were established to oblige all citizens to accept paper currency as a liberatory means of payment. Notice that due to an error in Peel's Bank Act, our gold was expropriated. A purely fiduciary monetary system was imposed on us, paper money, and a central bank was created as a lender of last resort with a contradictory objective: to keep watch and guard against inflation, but also to inject all the inflation necessary to bail banks out. And this is still going on today. The central bank continues to orchestrate credit expansion, which is brought about through fractional reserve banking. And every few years a bubble forms and is accompanied by widespread malinvestment, a financial crisis, an economic recession, great suffering, and high unemployment. It is shameful that nearly 2 decades into the 21st century, the poorly named market economies are still burdened with this financial system. which is simply the result of a historical accident. In fact, if anything characterizes this system, it is that it has nothing to do with a market economy. And if that is not true, please tell me where in the field of money and banking I will find the market economy. We have public money. Our gold has been expropriated. We have legal tender laws. We are compelled to accept public money as a liberatory means of payment. And we have a financial central planning agency called the central bank. Central bankers insist on gauging the demand for money and establishing the optimal money supply. They set by decree what should be the freest and most important price in the market, the interest rate. They orchestrate credit expansion, and they are ultimately to blame for all the harm we are suffering. And yet, when a crisis hits, what do we read in the newspapers? What statements do we hear politicians making on television? That this is proof that the markets do not work, and that we need more regulation, bigger government. Do we not hear this? And people believe it, and they swallow it. Ordinary people are convinced it is true. This is a complete outrage. And I hope that as mature students of this university and disciples of mine, you will do everything possible to dismantle these very harmful theories. You will find that the doctrine of a 100% reserve ratio is long established. Read the references Hume makes to the Bank of Amsterdam. But the important thing to remember is that in the end, a false debate arose between the theorists of the currency school, who defended the central bank, and the theorists of the fractional reserve banking school, who defended fractional reserve banking. Ultimately, the latter realized that the central bank was enormously useful to them whenever the outlook was bad, and private banks needed to be bailed out. However, in this debate, the most significant option was overlooked, and that was a free banking system subject to general legal principles. In other words, a 100% reserve requirement, which we covered in the early chapters. This would mean a purely private currency based on a system like the gold standard, and without a central bank. The elimination of the central bank demands that private agents act according to the principles of property rights. As we saw in the first 3 chapters of the book, this requires that in deposits of fungible goods, the tantundum, or the equivalent in quantity and quality to what was deposited, be kept always available to the depositor. In other words, in the area of the bank deposit, a 100% reserve ratio must be maintained. Only a handful of theorists, in France, in Germany, in Austria, realized that the healthy monetary prescriptions of the currency school could be adopted only in the absence of a central bank, and with a 100% reserve requirement for private banks, in a free banking environment. This is the tradition of Czernuski, of Hübner, of Telkamp, of Geyer, and of Michaelis, and it is the tradition Mises reflects in his treatise and first important book on economics, The Theory of Money and Credit. The title was poorly translated. A more accurate translation would be The Theory of Money and Fiduciary Media, which we know are deposits unbacked by saving. Anyway, the title was rendered as The Theory of Money and Credit, when credit is actually the balancing entry for deposits unbacked by saving. Turn to page 645, please. And you will see that there are really 4 schools. This is very important. In the column to the left, we see the banking school, which defended a fractional reserve, and below, the currency school, which defended a 100% reserve ratio. Then, at the top, we find the free banking school and the central banking school. Initially, the theorists of the free banking school defended a fractional reserve and free banking, while the theorists of the currency school defended the central bank. But later, fractional reserve banking school theorists ended up in the arms of the central bank. Note the arrow, which indicates the natural evolution of the banking school, and points in the direction of modern-day Keynesians and monetarists, who defend the existence of a central bank and a fractional reserve system. Meanwhile, the theorists of the currency school eventually realized that the best way to achieve their goals of stability and solvency was through the adoption of a 100% reserve ratio. Note the arrow at the bottom, which points to the left and indicates the natural evolution of the currency school. This is where we find those theorists I was mentioning: Mises, Hayek, Rothbard, yours truly, Joseph Salerno, Hans Hermann Hoppe, Walter Block, etc.